Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Thursday, September 22nd, 2022. Hope you're all having a great week. We have a lot to talk about today. We had the Fed decision yesterday, a lot of impact for the markets, more focus on what Powell said than what they actually did. So let's break it down and why the market, I will explain why I should say, the market has a crisis of confidence in this Federal Reserve that is contributing more to the declines than anything they are doing with policy. So first for the facts, the Fed raised rates another 75 basis points, 0.75%. This makes multiple interest rate hikes in a row. The Fed has raised interest rates at a pace that is the quickest in history, right? This is unprecedented. We've never seen anything like it, and therefore the markets are trying to digest this. The big problem for the market right now, when the numbers were released, and I'll bring up a chart here in a moment, we saw extreme volatility. Now, this interest rate hike was widely expected, right? We knew that 75 basis points was coming. It was fully priced in, 100% probability that it was happening. Yet the market whipped around in multiple 100-point increments right after the news was released. First falling, then rising, then falling, then rising, then falling, and going out lower on the day. Now, why was the market so volatile if we knew the interest rate hike was coming? And the reason for that was the language that Fed Chair Powell used. Okay, we're talking about his forward guidance, the expectation of where rates would stop rising, right, where they would stop hiking to, and ultimately what the impacts would be. So now, to put this in full context, you have to understand what Powell has been saying to understand why what he said yesterday was a surprise. So you go back 12 months ago, right? This was the Fed chair that told us inflation was transitory, that they were not even thinking about, right? Double quote there. Then we're not thinking about raising interest rates. And he said inflation would come back down to 2% by the end of 2022. Here we are, approaching the end of 2022, the September press conference. The Fed chair comes out and says, oh, and one other thing, he said that we will not cause a recession by raising interest rates. Yesterday, Powell comes out after 10, 11 interest rate increases, right? The same Fed that wasn't even going to think about hiking rates. And he says inflation is not going to come down to 2% until 2025, maybe 2026. So this Fed that could not forecast 12 months out effectively is now telling us what's going to happen 3 years from now. So you can understand the confusion from investors. Furthermore, he said, basically, all bets are off, folks. We don't know if this is going to cause a recession. Now, Jerome Powell, before his role in the Fed, was a private equity executive at the Carlyle Group. He understands the economy very well, and he certainly knows what raising rates at this speed is going to do to the economy, and that's either put us into recession or we are already in a recession, depends on what camp you're in. We think we're already in a recession. I think stocks are behaving this way because they know this, and stocks are always ahead of the economy. Nonetheless, this is what Powell said, which left many market participants just flummoxed, right? We went from not raising rates to jacking rates to the moon. Inflation's going to be 2% at the end of the year. It's transitory. No, it's not. It's going to take 4 years, right? So what are you supposed to think? And oh, by the way, he says unemployment will likely rise through this process. So just to put some numbers on that, for every 1% rise in unemployment, that's 1.3 million jobs lost. Okay, so how far do you think the Fed wants to go in fighting inflation? But here's my problem with the Fed. I believe the Fed is driving this car by looking in the rearview mirror. And what I mean by that is the Fed is looking at one thing and one thing alone to guide their interest rate decisions, and that is the Consumer Price Index, the CPI. The problem with the CPI is it tends to lag by 2 months. This is why the Fed constantly makes policy mistakes, right? Because by the time they know that they've cut rates too much or raised rates too much, they're 2 months behind the curve. And then they have to scramble to go the other way. Mark my words, this time will be no different, folks. Okay? So, but Mike, what do you know that the Fed doesn't, right? Fair question. Let me show you what we're looking at. So number one, you have to understand that most of the inflation pressures that we have faced were supply chain driven COVID related issues. So in order to look when inflation is going to peak, you need to look at some of the areas that inflation first showed up in a big way before it hit the real economy. And these were things like used auto parts, used cars, shipping rates, transatlantic, transpacific shipping rates. Those are the areas that exploded showing cost increases before we saw inflation hit the CPI, right? So naturally, those are the areas we should be looking at to see when inflation is going to peak and start to deflate. So let's get into some of the numbers here. Here's the Manheim Used Car Index, okay? You see, when COVID hit, right, the used car index took a hit because we all thought the world was ending. And then it exploded higher, right? This was the first sign we were going to have inflation, folks, in a big way. Exploded higher, couple stops along the way, but basically moved higher unchecked for the better part of a year and a half. Well, look at what has happened to the used auto index. It is not just returning to form, folks. This is cratering to pre-COVID low levels. Okay, this is a major leading indicator on inflation. And I can show you the used auto parts index. It's the same thing. Okay. Let's look at Baltic freight rates. Okay, again, COVID happened. Shipping freight costs exploded higher. They have fallen off a cliff. They're down about 55% from their peak. Now, again, we still have some ways to go to get to pre-COVID levels here, but shipping containers, cross-Atlantic, cross-Pacific containers, the cost has come down dramatically. Let's take a look at gas, right? Oil. We've seen 3 months of falling oil prices, okay? In a very big way, which basically takes us back to the beginning of 2022. Again, price is still higher than 21, we'll give you that. But these things are all moving in unison in the same direction. So what this suggests to us is that inflation, that COVID-driven inflation is largely in retreat, and the Fed has blinders on and they don't even want to acknowledge it. What we also see is that the economy is softening. We see companies laying people off. We see more job openings, right? We're seeing some slight changes in the unemployment rate. If the Fed is not careful and they continue to drive this home and drive far and fast with interest rate hikes, they will create a deep recession. I think the one we're in now is very shallow, and we can likely get through it without most people noticing we're having it. But if they continue on this path, they will ultimately make a mistake. How do we know that? Because all the Fed does is make policy errors and then rush to rescue us from their policy errors. They did it in 2008, they did it in 2011, they did it in 2015, they did it in 2018, they did it in 2020. You tell me if you think this time is going to be different. The question is not if, the question is when. Okay? Here's another thing we find very interesting. The Fed can keep jacking rates all they want, but what they're doing in the process is substantially increasing our interest rate expense on public debt, right? There's no secret the U.S. has a lot of debt, 22 trillion-ish, depending on when you look, it's constantly rising. Well, the Fed is raising rates and it's making the interest expense higher and higher and higher. So they're playing banker with their own debt. You tell me how high you think they really want to go, okay? Let's take a look at the markets. Here's our market, okay? Now, we've had a lot of great conversations with folks over the last couple weeks, couple months. Everybody's scared. We get it. We get it. This is not easy. This is not easy. But it's our job as your advisor to take emotions, to put them in a box and put them off on the shelf and make decisions based on real data and facts that are in front of us. The reality is, folks, yeah, if you look at a one-year view of the market looks awful, right? Just dreadful. We look at a three-year view of the market and we say, okay, much more constructive. And you may be thinking, but Mike, I don't care. I didn't buy the market down here. Fair enough. If you're a new investor, you're probably not liking what you've seen so far. But folks, the market's rallied 140% coming out of the COVID low. A 25 to 30% decline is well within the cards. Nothing is broken here. Nothing is broken. Now, if the Fed keeps on unchecked, could they very well break something? They certainly could. That remains to be seen. Let's be hopeful that that's not the case. But nonetheless, we have a market that's trying to figure itself out here. We look at the last 9 months. We know the initial bottom was for the market on or about June 17th. Markets moved up pretty well off that, but could not break through that overhead resistance that we've talked about many times, right? Just a brick wall. One day, folks, we will get through it, but unless or until we get above it, we have to live here below it. So now every market watcher is looking at this level, right? Is the market going to bounce off this level, which would be very constructive, would be considered a double bottom? That would mean that we have a lot of buyers down here at this level and market is exhausting and running out of sellers. Or are we going to knife right through this level? Okay, our case has not changed. We said it from the beginning. We'll say it again. I think in a worst case scenario, and we've emailed this out. We've talked about it. So you can go back, check your emails. Early July, we talked about it. I think the base case for the market, worst case, not the base case, is market bottoms around 3,400. So yes, there is some more downside to go. So why don't we sell everything now? The reason we're not going to sell everything is what you have to remember about the S&P 500. 22% of the S&P 500 is 5 companies. 5. Amazon, Google, Microsoft, Meta, Apple. So it is very possible that many individual stocks can have and already have bottomed and can start to diverge from the index even if the indexes continue to go lower. Now, what are we doing proactively? Well, we have raised cash levels. We've done that over the last month. You've seen that. We've talked about it. And that is our dry powder that if and when the market either double bottoms here or comes down into the lower end of the possibility range, we need to be buyers. We need to be nimble and we need to nibble at those levels. These are the buys that are going to reward us substantially when the market gets back to the business of doing what markets do, and that is going higher over time. Okay, again, short-term view, market looks like heck. Long-term view, I'll take this any day of the week. And this will come true yet again, folks. Markets are not just going to die on the vine here and go extinct. Another thing we want to share, just into the magnitude of the fiscal tightening. For those who would say, no, the Fed hasn't done enough, they have more to go. All right, we want to share this. All right, clip the tweet here from my friend Charlie Valello. Shares a lot of great information on markets, data, etc. 2 years ago, the 30-year mortgage rate was 2.87%. The average new home price in the U.S. was $405,000. Okay, today the 30-year mortgage rate is 6.3%, and the average new home price is $547,000. Okay, substantial difference. What this basically means is we have seen a substantial increase in the down payment needed to buy a home, and monthly payments for that very same mortgage have gone up 100%. The Fed can push all it wants. If it keeps pushing, they will get a housing recession. We still think demand right now is strong enough and supply is low enough that that's not where we're headed. But if you think the Fed's not aware of all this, they certainly are. Okay, and these are things that bear watching. Okay, so again, we need to keep things in the context of the move. Let me talk about one stock in particular that I know is causing people a lot of pain, a lot of angst. People are starting to give up on. Okay, let's look at our friend NVIDIA here. We look at the last year, right? Terrible stock. Who would want to own it? Who knows what they do? No one even cares. We obviously know, but a lot of people don't ask questions. They look at price. No problem. Well, it's important to keep context, okay? Coming out of the March 2020 low, we just talked about the stock market. It went up 140%. Okay, NVIDIA went up about 450%, same period. So do you think it's fairly natural with the markets down 25% that NVIDIA could be down 50%? We certainly do. We certainly think for a stock that's animalistic like this that can rise 4 to 5 times what the market does on the upside, certainly it could go down 2 times what the market does on the downside. This stock is not broken, folks. It's important to look at NVIDIA and know what they do. They advance like, hell on wheels. They sell off, right? Everybody forgets this. For those of you that have been with us 5 or 6 years or longer, we started buying NVIDIA 2017, 2018. Remember this decline? From 70 down to 30, right? People forget short-term memories. Look what it did after that, right? And then again, here we are. We're in a decline. So you tell me what you think comes next. But when the market bottoms, quality companies will lead the way back up. And stocks that outperform on the way down, or let's call it underperforming, right? Stocks that have gone down more than the market can certainly go up much faster than the market too. There's a lot of examples like this that we could point out, but again, we all have a tendency to drive looking in the rearview mirror. We look at a stock like this, we look at a chart like this, and we say, I would never buy this stock, right? It looks awful. Well, I'm sure a lot of people said that at points in the past, right? When stocks declined. NVIDIA has done this, folks. It did it in 17. It did it in 18. It did it in 20. And it's doing it again in 22. So we think this stock will rise again. It will rise to new all-time highs. And that is true across the market. But right now, we have a void of buyers and we have more sellers than buyers because fear is winning out. It won't win forever. And ultimately, we're almost through September, which is the worst month for stocks every year on record. We're coming into October, coming into the fourth quarter. There's a lot of new money that's going to flow into this market. Okay, and there was one other thing I wanted to share. Let me not forget it. This is super tiny. Let me see if I can blow this up. Okay. This is a clip of talking about a great quote, right? Somebody was a principal years ago of Acorn Funds, big investment management company. Ralph Wanger. Okay, Ralph, he likens the market to an excitable dog. I'll just read it. I'm not going to paraphrase. A lot easier to read it. He likens the market to an excitable dog on a very long leash in New York City, darting randomly in every direction. The dog's owner is walking from Columbus Circle through Central Park to the Metropolitan Museum. At any one moment, there is no predicting which way the pooch will lurch. But in the long run, you know he's heading northeast at an average speed of 3 miles per hour. What is astonishing is that almost all the market players, big and small, seem to have their eye on the dog and not the owner. Folks, the owner is the economy, the dog are stocks. Okay? We know where the economy's going, slow and steady. With some hiccups, sure, recessions, of course, things happen. But we know over time where the economy's going. The stocks are like the dog. They get distracted, they lurch at things, they bark at things, but over time, they're going to keep pace with that owner and they're going to get to where they're going. So we hope this is helpful. We're always here to talk to you about anything that's on your mind. It's been a tough road for investors. Hang in there, keep calm, invest on. We're going to get through this. We're almost, I would say the market bottom. We're working on one here. 33, 34, 3,500, whatever it turns out to be, we think will be a fantastic buying opportunity. So reach out to us with any questions. We'll see you back for the next Heritage Market Update.